Greetings of the day. Welcome, students. Today we are about to start our next unit, that is Unit 2. As I informed earlier, that Unit 1 is not that big, it is a small unit, but is very important because it gives you the outlook of the subject because it is something new for you. Management accounting, you have not studied that before. So it gives you the information that how it goes. I would like to introduce Unit 2 here, that it has three parts. In the very first part, you will be studying the financial analysis. Then second part gives you the idea and practice of ratio analysis, and the third and the last part is cash flow analysis. This unit is very important from the viewpoint that you get numericals from this unit. You would be able to see a question, numerical question from ratio analysis, a full-fledged question to calculate the different categories of ratios that we have, and quite possible that you would have a question from cash flow analysis even. So out of these three parts, we are about to start the very first part, that is financial analysis today. Under financial analysis, the first term, the first category that comes to talk about is financial statements. So today we will be studying about financial statements, and then slowly we will move towards financial analysis. Okay, to begin with, financial statements, you are very nicely aware that what financial statements are. Since your class 11, you are continuously studying the financial statements, being a commerce student. Financial statements provide a summary of the accounts of a business enterprise. If see, I have quoted a certified definition also for you given by the American Institute of Accountants for financial statements. Let us see what this definition talks about. Financial statements reflect a combination of recorded facts, accounting conventions, personal judgments, and the judgments and conventions applied affect them materially. See, we know very well that where the term financial comes, that talks about the monetary transactions, the basic transactions that you are doing. And for that, you have studied various principles, rules, and regulations according to which we record them. So, first of all, it is a combination of recording, and second, following certain conventions, certain rules, certain principles, using which you record your transactions and analyze them. And personal judgments are a very important part in that because it totally affects the quality of your summary of the books of accounts. That how your chartered accountant or a management accountant is interested in recording the transactions which are taking place in an organization, because we know that the management accountants are supposed to take monetary as well as the non-monetary transactions into account, because they also affect the functioning of a particular business. Okay, let's move further. You know that financial statements exhibit the data I have just talked about are combined under the effect of three main parts, that is recorded data, accounting conventions, and personal judgments. I've just discussed this. Let me throw more light on this particular part, that what are they. See, they are recorded facts, so you cannot change them, you cannot manipulate them. Error can be there, but we try to avoid that. And then we do have certain accounting conventions. To remind a few, you had various conventions, various principles, like your dual aspect concept, that every debit would have a credit, your going concern concept that takes into consideration that the organization would go on for a long. Then you have further conventions like materiality, realistic, and so on. You have studied that in financial accounting in detail. And personal judgment is very important. I just talked about that how the transactions are being recorded, with what perception is again important. So data in the financial statements is the result of the combined effect of these three factors. The result shown by a financial statements is a combined effect of these three factors. Okay, if I move further to the types of financial statements, you have the two basic statements, that is a balance sheet and a P&L account. I don't think so. These are new terms for you, so you know them very well. That balance sheet is also known as a statement of financial position, and it reflects the assets, liabilities, and capital on a certain date. And in general, you prepare your balance sheet as on 31st March of the particular year, because that is the last day of, considered as the last day of the financial year. So you show the statement, and through that statement you show the financial position of the organization, reflecting all the assets, liabilities, and the status of the capital of the organization. Then profit and loss account, is very well even known as income statement, and it shows the results of the operations, means whatsoever operations are being performed in your organization in the whole year, out of that you have earned profit or you have suffered loss during that particular period. So the basic difference, that balance sheet is prepared on a particular date, whereas P&L account is prepared for a certain duration, and in general that is prepared annually for a particular financial year. Beyond these two statements, we do have other statements also, which help to determine the financial status of an organization, and helps the managers and accountants to take the decisions, and even the high top level management also to take the further decisions. And in that series, if we have two basic statements, further other statements beyond these two, we have funds flow statement and cash flow statement. The funds flow statement is now not there in your syllabus. It was there till 2017, but now it has been removed due to certain reasons. And but let me give you the outline. Some of you must have studied these two statements, funds flow and cash flow, in your class 11 and 12 in your CBSE syllabus. So some of you may have idea, but some of you may not have studied. So let me give you an outline that what funds flow statement is. Working capital. Working capital is the fund which you use for the purpose of generating your operations. The day-to-day requirements are met through the working capital, right? So the funds flow statement is the statement of changes in the working capital. Means that if there is any increase or decrease in the amount of working capital during an accounting period, is shown by the funds flow statement. Then we have cash flow statement, which truly deals with the amount of money that is held by an organization. Basically, it defines the position of cash during the beginning. Like, it is considered like what was the cash at the beginning of a particular accounting period, and what debits and credits you had with the cash, means where you spent the cash or where you received the money, and at the end of the particular period, what is the amount of cash which is standing as per the debit of your account. So cash flow statement totally and truly deals with the flow of cash only. So these are the basic types of statements that we do have in financial analysis, that we perform analysis on these statements. But to introduce with these statements, we have seen that these statements are actually prepared on three basic factors. That they are the recorded statement, means that is a factual information, that like your cash in hand or cash at bank, or the cost of fixed assets, or the salaries that you're paying to the your workers. See, these are like three factors. They are recorded, certain accounting conventions are there, personal judgments are being affecting these financial statements. These are the three factors which affect these, and beyond that even they suffer certain limitations. So they are even an important part here, that these financial statements, along with the usability, their usage, we do have certain limitations of these financial statements as well. So it is a general impression that financial statements are precise, exact, and final every time. But sometimes these statements conceal some very important information, that they try to hide certain particular things or some data gets manipulated due to the personal judgment of the accountant, or it can be an error even. So they suffer certain limitations. Let us discuss one by one. The effect of accounting concepts and conventions. You have studied various concepts and conventions of accounting, which affect the value of your assets and liabilities as shown in the balance sheet according to different concepts and conventions that we follow. So same ways, profit and loss, which is disclosed by a P&L account, is also affected by these concepts and conventions. Like if I take an example, the account of a going concern concept and also the convention of conservatism, the balance sheet does not show the current economic value of the various assets and liabilities. A very best example I can give you from this is, like, suppose we possess an asset called building, and it was purchased in 1970s for suppose 80,000 rupees. Do you think that building which was purchased in 1870s, now after 50 years it would have the same value? But in the books of accounts, appreciation to such assets would directly affect your profits and losses, so they are actually not appreciated or depreciated accordingly. So the from here we can see that the current economic value of the assets and liabilities are not shown truly by your books of accounts, and that happens due to following certain concepts or conventions. So these concepts and conventions do have a direct effect on the recording. So it is a concern that we are not able to find the real economic value of our assets and liabilities. The second limitation under this is that there is an effect of personal judgment. We have discussed this also before. Now let us take some example to understand this further. See, financial statements can be influenced, but to a certain extent, not fully. Now, in this example, I would like to take, suppose, the amount of provision of bad and doubtful debts. You know that it depends entirely on the judgment and the past experience of the accountant, that what kind of provision he is about to create for the bad and doubtful debts. Similarly, as an accountant, he has also to make a judgment about the method and the rate of depreciation for fixed assets that he is about to charge. Because you know that the two basic methods that are used, the straight line method and the diminishing returns method, under fixed interest method, the straight line method, the value of asset becomes zero after the certain period of time, after the life expires. But under the diminishing balance method, there you do not have, like, the asset does not become zero, but at some point of time the asset may become useless and would possess certain scrap value and would need to get sold out in the market, and the asset may need replacement. But do these financial statements are telling you all this? Is it shown by the financial statements, your P&L account or your balance sheet? Is it showing that? So there are numerous instances where an accountant has to exercise his personal judgment, in which there is an element of subjectivity. So the quality of financial statements truly depends upon the competence and the integrity of those who are responsible for preparing those statements, that what kind of information are they disclosing through these books of accounts. Next is recording of monetary transactions only, that I have also discussed while I was teaching you the definition of management accounting, because you know that these financial statements record only the transactions which are monetary in nature. So there are many factors which are qualitative in nature and cannot be expressed in monetary terms, and these non-monetary factors do not find any place in these financial statements because they do not record them. Like if I talk about the efficiency and loyalty of workers, now tell me, does that affect the profit and loss of the organization? Yes, you have studied that in cost accounting. The efficiency and loyalty straight away gives an impact on the production and the level of profits. The number of hours that they are wasting purposely, the idle time, the cost of that idle time affects a lot gives a lot of effect on your profit. Like personal reputation and integrity of the managing director of the company. Sometimes you can call them as owners even. Advertisement policy of the company, and are not capable of being expressed in monetary terms, and so thus they do not find a place in the financial statements, though they are very important. Uh, so this is a very important, it is a very big limitation of the financial statement somewhere or other. The next is that they're historical in nature. Under economics, you have studied that many a times that certain factors are kept constant, which is actually not possible to keep in market. Prices are kept constant, which is actually not possible and realistic in nature. You have studied that. And here we actually have, we work and analyze the historical data. So sometimes it does not prove to be relevant as per the current situation, which is being existing in the economy or the market, and which is applicable on that particular company at that particular moment. So financial statements disclose the data which is basically historical in nature, and they tell what has happened in the past, and they do not give any future projections, and it ignores the human resources. No business can prosper without an efficient workforce. You understand that very well. Financial statements do not include human resources, which is actually a very important asset of an organization. And somewhere or other, we can say that the whole organization actually stands on the shoulders of these human resources only, because they only utilize the other resources to produce those profits and losses. The last limitation here out I have marked as ignores the social cost. Now, what social cost am I talking about here? See, a business has certain social responsibilities. You're right, the corporate social responsibilities only I'm talking about here. So, financial statements do not make any attempt to show the social cost of its activities. And the examples of the social cost can be the cost of a manufacturing company, like air pollution, water pollution caused by it, and occupational diseases which the production process may be leading on. Sometimes accidental cases can be there, work injuries can be there. So, apart from earning a fair return on investments, a business has certain responsibilities also that they need to keep under consideration to have a goodwill in the society, to have a good reputation, and so that the people are interested in your organization, that they're both ways, that if they are interested to work in your organization, whether they are interested in buying the product of your organization, anyhow they want to be in connection with your organization. So it totally depends on the social reputation that the organization holds. And these financial statements, basically your balance sheet and your P&L account, never talks about such kind of social costs. So it is a limitation of that. So hereby we have given the introduction to your unit 2, whereby the first part we have to study the financial analysis. I have given a quick revision of your financial statements, their types, and the basic limitations that they bear. In the upcoming lecture, we will be discussing that what financial analysis is, that like how the statements are being analyzed to take various decisions, and what are the types of analysis we have. So we will be continuing in the next lecture. Till then, keep studying, keep safe at home, stay healthy. And if you have any queries, you may write to me. Thank you so much. Bye bye.